If you carry inventory, how much gross margin do you get for a product you don't have? Nothing. Do not decimate your inventory levels, but learning to build quickly, collect quickly, get support, work with your vendors to make them a partner almost to the business where it's feasible, but it's got to be something in it for them, but not necessarily changing price.
1, 2, 3, 4.
Welcome to the Small Business Mentor podcast, where we shine a light on the black holes of business growth with your host, Alan Pence. In each episode, we explore the leaps and bounds entrepreneurs make as they push their businesses beyond the 1 million mark into the realm of professional sustainable growth. Stay with us as we navigate the journey from brute force to finesse.
So today on the pod, we have Greg Crabtree, the one, the only, the legend. I call myself the small business mentor, but this is the small business mentor's mentor. He's like the Yoda of small business, I think. The great one and only Greg Crabtree. And welcome to the pod today, Greg.
Appreciate it. Thanks for having me. Always glad to be here.
All right, Greg. Well, let's start with the oldie but goodie. It's the thing that brought me to simple numbers in the first place, was understanding labor efficiency. So first tell us why it's important and then how to understand.
So when I started this journey, I hate accounting. So it's like I had to find something else to do. And so,
and for people who don't know, you are an accountant, right?
I am an accountant. Yeah. Like, my goodness, it's a profession that lost its way 40 years ago, but that's a different podcast for a different time. But, always loved the concept of consulting, but there again, everybody's kind of got their stick. Are they a business valuation consultant? Are they a process improvement consultant? Are you an industry guru? And those kind of things. And I go, when I joined EO, this is my tribe. This is my kind of people. And I really respect two types of entrepreneurs. The one that can create a business that didn't exist before, and not a fake business. I mean a business that truly does what the market needs, does it profitably, and they're effective at telling the market about it and growing it. That's my number one favorite entrepreneur. And I'm lucky enough that I got a handful of clients that meet that criteria, and I respect the heck out of them. And oh, by the way, over half of them are women, just to let you know. The creative ones, it's like, that's pretty neat to see. The second one is the person that finds a way to be extraordinary in the ordinary. And I love the necessary businesses, but can you do a necessary business in an exceptional way? And so they're not a client of mine, but certainly what comes to mind is Powell's Sudden Service, the little 30-store hamburger chain in Kingsport, Tennessee, that just an incredible business. Just an absolutely incredible business that just beats the socks off of both profitability, meeting their customers' expectations, and running with flawless efficiency day in and day out. And it's like, man, that is the trifecta. And that's what makes them the most profitable per square food food establishment in the U.S. And it's a company that the vast majority of the U.S. doesn't even know about. It's incredible. But we've got clients, what I would say is we have several industry groups that we run mastermind sessions and collect data for. And one of them's we got an IT group of MSPs. The one that really continues to knock my socks off is our HVAC group, about 12 businesses, a little over 100 million of revenue. And to see them go from where we started working with them to really get the right signature of profitability across the group, see them continue to adapt in an extremely difficult market over the last 4 or 5 years and be very strong and stable businesses, not egregiously profitable, but yet using the marketplace of saying, I can raise prices when I'm a necessary a lot easier than I can raise prices when I'm a discretionary. And so those businesses done well, in spite of a very difficult labor market that requires certification, skill set, and human development, because the industry is still short of HVAC techs globally.
So that's one thing I notice about a lot of small businesses I see, right? And not your clients, but others, is that they don't really understand the investments and costs that drive their business, right? Mm-hmm. So one of your big insights, right, originally working with these EO companies was that labor is almost everybody's biggest expense / investment.
It is,
right?
Absolutely. and when I joined EO, what was funny is all the entrepreneurs would talk about, man, the next business I start, I don't want to have to deal with employees and I don't have to deal with customers. And I go, great, you just won't have a business then. And guess what? Most entrepreneurs who sell their business too early, they never get back into business again because of the two things that you have to deal with is customers and employees. There's not a single business that grows without leveraging of labor. And it's just I have to.
So talk a little bit about your way of managing it.
It was an interesting intersection of two problems. Number one is my constant aggravation of the over fascination of revenue. And not every revenue dollar is equal across all businesses. And I was taught early on, the seed was planted originally, and then it got confirmed later by a client of mine that was a government contractor. And, he was $18 million business and he was making 2% net profit. And I said, Russell, this is not acceptable. I said, you got to find a way to improve profitability. He says, you don't understand. I'm not an $18 million business. I have to subcontract out 50% of everything that I do. Exactly right. You're a $9 million business, right? And guess what? That makes you 4% profit, which is still not acceptable as a level of profitability. So but he taught me a lesson that always stuck. And then when I started really just going to the data without a pre-context of proof text of what I was going to try to prove or whatever, I just let the data tell the story. The first thing was figuring out that I wrote about in the first book. If you look on page 22 of the first book, I show an example of a $20 million construction company and a $3.7 million services business. And after you filter out their COGS, they're exactly the same business. And that part, that was just a light bulb that goes off and you go, oh, if we just eliminate pass-through cost of goods sold of materials and subcontractors, and then get to our labor and our operating expenses, all of a sudden, every business model looks pretty close to the same. I mean, it has some different characteristics on the balance sheet from a funding, but from a P&L standpoint, I can now create a consistent profitability target based on profit to gross margin, not profit to revenue. I had a call with an Australian client last night, and I was telling them that, they were looking at this profit at about 50% cost of goods sold for the business unit we were looking at. And they were looking at this really small percentage of profit. And I said, that's a bad number because one, the movement is so small, you don't really get a sense of, am I doing better or worse? I said, if you make that a profit as a percent to gross margin, now you feel the movement up and down much more significantly. So the same business that would be at 6% profit to revenue is at 15% profit to gross margin. And if it moves to 5% profit to revenue, it means it's probably dropping to like 12% profit to gross margin. And therefore, it's like, whoa, that 1% move as a percent of revenue is just not nearly as mentally significant to you as that when you start focusing on that profit to gross margin. And so that had to be the first step. And so once I got to there, then I just started a process of saying, what numbers are the most sensitive to the movement in gross margin? Well, undoubtedly, labor. Labor is generally somewhere around 50 to 60% of gross margin. It's closer to 60% in a bad business, and it's closer to 50% in a good business, regardless of whether it's direct or management. Forget about classification, just take all payroll. And so then when I started tracking it, and I said, well, how consistent is this across all business? Dang, it's like the group I talked to in Houston yesterday. I did a presentation for the EO Houston chapter, and I said, guys, I want you to remember one number from this presentation. You ready? I want you to write it down. 2. Got it? Can you remember 2? I said, 90% of you, maybe even more, need $2 of gross margin for every dollar of labor, regardless of what that labor does. I don't care if it's the CEO or somebody who sweeps the floor, all counts. And the signature of the number of businesses that respond to that one simple metric is stunning. This is the metric that drives business that's been hiding in plain sight for decades.
So just to cap for people following, you take your revenue, take out all these pass-through kind of costs, like subcontractors, that would probably include some 1099, so you aren't really managing. Sometimes 1099 is labor if you're really...
That's right. If you really, I'm not trying to be IRS compliant or DOL compliant, but if you kind of really control that person and tell them when to work, when not, and all that, they're labor. But when you've given a piece of the business to somebody else, theoretically, I got to allow profitability to go with that too, because I've carved off a piece of that and I'm handling what's left over.
And so now you're down. So you take out these materials, pass-through costs. You're down to what you call gross margin, right?
Right.
It's not what an accountant would call gross margin.
Right.
And because they would take out direct salary.
So there's very few accounting terminologies that there's universal definition for. Now, working capital is a universal definition, current assets minus current liabilities. I use a different number for that, so I don't try to redefine working capital. But you will not find a consistent definition of gross margin. There's one belief that gross margin is the percentage and gross profit is the dollar amount. Well, it's like that. Who came
whatever that means.
And so gross margin, and in my first book, I actually do call it gross profit, but I've since changed it to only be gross margin. And I got to credit Vern Harnish for this. I mean, Vern and I contributed a chapter to his Scaling Up book. And when I was writing that chapter, he and I had a great discussion, and I thought this was just an incredible insight. Vern said, the word gross profit or the term gross profit is really kind of messy. I mean, it confuses people because the word profit. And he said, we really should keep the word profit for the bottom line. And I thought about it. I said, well, Vern, I think you're right. And so I'll just use gross margin. And ever since I wrote that chapter for Scaling Up in 2014, that's the way I've referred to it. And so then the idea becomes, and so this is the other change in nomenclature, is every time that I use a subset of a value activity, I use the word margin with some type of modifier. And so the idea, I'll give you a great example. So when we work with retailers that have multiple channels, so the first thing we want to look at is product gross margin. The second thing we want to look at is then channel gross margin. And then the last thing we look at is channel gross margin after marketing spend for that channel. And so there's actually a 3-step down if you really want to get detailed in a retail direct-to-consumer sale environment.
And so once you kind of understand it at this level, right, you can start splitting it up. So going again, revenue minus sort of pass-through subs and materials, you get gross margin, and then you divide your total labor dollars into that. And you're probably going to end up around 2 if you're decently
profitable, you're a 2. If you're hanging in there, you're between a 1.8 and a 1.9. If you're below a 1.8, you're wondering why cash flow sucks. Your problem's not cash flow. Your problem's profitability.
So talking about how you go below that, you then disaggregate labor and you say, all right, there's direct labor that directly serves a client or a product.
Right.
And then there's sort of the back office management labor. And you split those two.
And everybody just goes way bonkers over who's in which bucket. I said, listen, don't worry about it. It's really simple. 30% or more of your time facing the customer, doing what you do for a living, put them in direct labor. Everybody else is management labor. And I call it management labor because management people have an ego. I used to call it admin labor, and the management people got offended. I said, okay, we'll just call it management labor, and it's got your admin people, it's got your management people. Now, here's the thing. One gives you a health diagnostic. The other two gives you a direction and labor strategy. So the way I teach it is total labor efficiency ratio is a momentary health diagnostic. I can look at that number and tell you, good or bad, are you a good business or not in terms of leveraging labor? But then when I take that number and then split it between direct LER, which is gross margin divided by direct labor, and then management labor efficiency is contribution margin. So gross margin minus direct labor is contribution margin. That's the output of the business engine. Contribution margin divided by management labor is saying, what is management doing for its 3 directives? Management's got 3 directives: drive revenue, control cost of goods, manage direct labor. I can win by any of those 3 measures if I hold the others constant. So management is held accountable to that dollar that drips out of the funnel of contribution margin. And you then get to decide which, am I failing on revenue acquisition? Am I failing on managing my direct cost? Am I failing on getting productivity out of the labor that I spend? Now, when we look at those ratios, they don't tell me anything immediately from a health perspective because I can have 3 different labor strategies. I can be heavy on direct labor, which means I have to be light on management. I can be balanced between the two, or I can be light on direct labor, which means I got to have a heavier management labor structure to overcome their lack of knowledge and deficiencies. But I can't be heavy. I won't be profitable. I can't be light, or I'll have customer service failures out the wazoo. And so there's 3 different ways I can win in that labor strategy. And so you just have to be true to it and not violate how you do it. And the way that you monitor it, though, is looking at it moving across time. This is really the core weakness in financial presentation. I mean, everybody goes out and hires their fractional CFOs, and they just keep producing the same crappy financial statements that our profession has dumped out. And it's like, no, you have to tell the story as it moves across time. And if I do not show movement of data, I have not effectively presented the financials of the company. And so I want to see, what is my direct labor efficiency movement year over year, rolling 12 is the first thing I look at for the last 3 years. I look at it this rolling 3-month year over year. And then I look at it monthly, which months are a really inaccurate period of time for most businesses. But then I look at it on a trend basis of what has it done over the last 3 months of a trend view of saying which direction is it going. Because we say all the time, I can actually predict your next 3 months financials better than you can. And all I have to do is look at rolling 12 and rolling 3 trends. And I will come closer than you will, unless there's something that you haven't told me that changes the direction of the business. But if you're just doing the same thing over and over again, I can predict trends better because I'm not emotionally tied to it in that process.
For some benchmarks here, I mean, obviously you said you can have different weights and formulations of this, but I tend to see like a lot of, I don't know, maybe service businesses like mine, professional services. You get like a 2 or 3 direct labor, and you tend to get a 4 or 5 management labor.
That's pretty common in government contracting.
Yeah, you should be getting more efficiency out of your management than your direct in that. And you'll see a lot of businesses kind of in that, but you can change that where you have, say you had like a ton of gray beard kind of consultants that were high end, then your DLER would be a lot lower, but your management labor should be really high because you shouldn't have to manage them.
It should.
That's right.
There's actually another version that you'll see in government contracting, and you'll also see in high-end staffing business. And it's essentially, there's 2 outliers on the high side. If you're a retailer or if you're a distributor, your total LER would be a 2.5. And what's happening there is there's just other operating costs in excess of the labor being deployed that makes that number come out. Like I said, I just sit here and watch the data, and it just comes out every time. So in a staffing model, the idea is don't count the direct labor because I don't manage it. I just recruit it and run a payroll check and leave it to the hands of the people I just staffed it to. So in essence, management LER of a staffing business is about 2.5. That's really their direct labor is their management labor in reality. And so in government contracting, you have 3 levels of government contractors. On the low end, I can run a 2.5 management LER and be at like a 1.6 or 1.7, what I call a body shop contract. You're into winning contracts that just rebadge a person. I didn't have to hire them. I just won it, and I just took over those people. And I'm told, don't bother these people, just run their paycheck. That's the government contract, body shop contracts. The second one is essentially kind of commodity services, which you're going to have probably a 3 management LER, but you won't get to about a 1.9 direct LER. But these tend to be really large contracts that deploy a lot of people. And once again, it's really kind of high-end recruiting with a little bit of light management. But then once you get into true unique skill set and services value, you're going to be the 2 total LER. You're going to be at about a 2.25, 2.3 to 2.5 direct LER. And you're going to be at probably about a 3.5 to a 4 management LER to get to that 2 total, in that. But there again, when people look at these ratios, they've got to look at them in the context of saying, why is that business different than mine? And there again, am I actually doing anything with that direct labor, or is really my management labor all my true labor? Then, like I said, I'm more of that distributor model.
I also love the story. I think you told it in the first book about disaggregating. You were talking about going down to channels, but you can look at service lines, right? And you had a lawn care business, right, where they were doing commercial mowing and I guess lawn care, which is like fertilization and stuff, right? Mm-hmm. And so the direct mowing, when you disaggregated to this direct labor, the DLER for each service, it was like 1 point.
They were a 4 for irrigation. They were a 4 for landscaping services, but they were a 2.5 for mowing. And so they actually shared this data with their direct labor team and said, what do you think? And the $10 an hour, you can tell how long ago it was in 2009, when this happened. So the $10 an hour mowing guy that was listening to that, he looked at it and he says, well, looks like to me we shouldn't be in the mowing business. And I use that story all the time because when I share this information with accountants, they go into cost accounting mode where they want to allocate payroll taxes and benefits and allocate overhead, and they want to split people. What about the time they're managing versus what? Is it stop it? It's called simple numbers for a reason. If a $10 an hour employee gets it like that and you don't, who's the idiot here?
That's really the power of it. Is like, and then you can look at individual employees. You're like, hey, not making that much money. You start go look how much money they're making versus what you're paying them. Bam, you'll see problems right there, right?
And here's the thing. We live under this delusion, and our profession as accountants, we cause this. We think that every business is unique. And I go, no, it's not. It's not that unique. It's not rocket science. Now, the execution, the style in which you do it, the strategy and all those things, okay, I'll give you that. But the numbers are not unique. And we have perpetrated this crime upon entrepreneurism. And I say this all the time. I'll go talk to a group of 100 entrepreneurs. And I says, all right, guys, if you all pulled out your P&L and put it on the table, 100 of them would look different. None of them would look exactly the same. Why is that? For an industry that's supposed to be good at standardization, we are not. And I said, unless you're one of our clients and you're going to be able to pull out your P&L and talk to another person in a totally different business and look at their P&L and understand it and have a rational discussion about how they leverage labor.
That's amazing. I'm in a mastermind group with Greg, and there's somebody there who owns like a gun range. There's a guy who owns like a demo and scrapyard business. There's a law firm. There's oil change business, and we're sitting there. I own a government contractor, and we're sitting there like looking at each other's businesses and able to talk fluently in between them because it's just so much simpler, right?
And I love it when you guys, I'm not doing the conversation, you guys are doing it because you understand how to let the data tell the story, and then you can ask really good questions once the data is unmuted. And traditional financial statements, we just put the mute button on and it's like, oh, okay, you got my statement? Yeah, stick it in the drawer. And you never look at it for practical purposes.
So to me, the first book is amazing. Everyone should read it. It's one of the core books I always recommend. Has a lot of different concepts in it, but I do think that like that labor, simplifying the numbers and then labor, that's like the brilliant insight, right? That is helps shape businesses.
And I did make a point in the second book, there is a total chapter dedicated to labor efficiency ratio of both the total number and the two, components. And I use a couple of case studies to go a little bit deeper. But it is one that it still takes people a little bit of time to get their brain wrapped around it, because all I've done is taken a labor as a percentage of something formula and flipped it. And I make labor the bottom number of the fraction. For those of you that are fractions challenged, that's called the denominator. The bottom number of the fraction is labor, and the top number is the output from the labor being the input. Because we have this backwards in business. Revenue doesn't create the labor. Labor creates the revenue.
Also, your labor, spread across your P&L. It's in accounts, and you don't know what it is in total, right?
Yeah, go look at a public financial statement of a public company, and you will not see labor isolated in a single one of them. They do not want to show you that.
So then, moving to the second book, it was really like, to me, obviously the big insight there was sort of this ROI concept that most business owners really don't use at all. So talk a little bit about that insight and how you came to it.
There was two reasons for that. One, I got turned on to the idea by a Wharton professor, David Wessels, who leads our EO at Wharton class. And so I've been able to chair that class, and I get to present some of my concepts and kind of moderate the week and kind of connecting, because the business school professors generally only have access to public company data. And so I'm there to kind of connect the stories and things that they use to the more practical real world of a privately run business. And there are some differences. One being, we can't immediately raise money by issuing stock like a public company can. But David, in that first year, he was talking about return on invested capital, and he kept making a statement. Return on equity is a flawed calculation. And that got my attention. And then, he talked about, how do you get to invested capital? Well, it's get rid of all the trash on your balance sheet that has nothing to do with the operation of the business. Every privately owned business probably has something on the asset or liability side that has nothing to do with the day-to-day operation of the business. So you just ignore those and make those adjustments to equity to get to the true invested capital number of where you're at today in the business. And then you're just looking at net income annually relative to that capital deployed. Well, in public companies, they do an after-tax number. Well, I've got to look at a pre-tax number because 99% of all private businesses are S corps or LLCs that are passed through, and you don't pay taxes at the corporate level. And so I've done my research to say, what is the pre-tax return? Because this then allowed me to do something I've always wanted to do, is convince you that your business is the best asset, highest returning yielding asset that you'll ever own if it's run correctly. And it's proven to be that case. I mean, the minimum return on investment that we see in a developed economy, we have clients in the US, Canada, and Australia, a few little dotted here or there. But let's take those three developed economies. We've yet to see a client who couldn't hit 50% return on invested capital. And once again, that also depends on the capital structure of the business of, do you carry AR? Do you carry inventory? Do you carry work in progress? Do you get accounts payable, trade support from your vendors? Do you get to bill in advance and have deferred revenue? Do you have a significant amount of accrued expenses that I incur the expense for a period of time, but then I have to pay it later? And so those are all funding techniques and also, capital investment techniques. And so we developed an ability to look at those and actually simplify the balance sheet into three numbers. What's your trade capital, what's your infrastructure capital, and then what's your buffer capital, which is cash minus line of credit. Those three numbers encompass 100% of the active accounts on the balance sheet that matter in business. And so the sum of those three accounts actually equals the equity, the invested capital in your business. And so instead of taking the balance sheet and putting assets on the left and liabilities and capital on the right, I turned it in a much more functional document of saying, am I capital efficient or not? And what's amazing is once we started showing this to clients that were capital inefficient, they figured out ways to get efficient with their capital. And where they had $5 million of capital deployed, they dropped it to $4 million. And when you drop the capital deployed to $4 million, guess where that $1 million went? It wasn't because I lost money. It's because I was able to distribute it freely as free cash flow to the owners of the business because they were wasting cash sitting there idle.
Idle cash.
And this was done by not depleting inventory to unsustainable levels. Hey, I'm a big believer. I said, if you carry inventory, how much gross margin do you get for a product you don't have? Nothing. So, do not, decimate your inventory levels. But, learning to build quickly, collect quickly, get support, work with your vendors to make them a partner almost to the business where it's feasible, but it's got to be something in it for them, but not necessarily changing price. And we've had clients actually win no price concession from their vendor to get more trade support. They just were able to do more with that vendor because of better terms. And so sometimes volume is an answer to a trade with that vendor. It doesn't always have to be, I'll give you a 5% discount. That's lazy business. There's different ways to deal with that.
So basically what you're saying is a regular company, if you're not overcapitalized, you don't have too much cash in it, just the right amount. Now you're 10, 15% profitable. You should be at least hitting 50% return on the capital inside the business every year.
Exactly.
Yeah. So, and then you've seen that scale up to what? 200%?
Yeah. The slide that I've developed and what I was sharing with the Houston guys yesterday is that, so if you carry accounts receivable and inventory, 50% return on invested capital is your target. You probably at best can get to 60, but 50 is going to take some hustle to get there, but you can, because I've got two really hefty capital components in that process. If I carry AR and not inventory, or inventory and not AR, then I should be able to hit 75% return on invested capital. If I don't carry AR or inventory, I sell upon service, I don't carry any product in inventory, or those things, those businesses should be 100 to 150% return on invested capital. And we've got some that's as high as 200. They're just, significantly profitable.
I want to benchmark that. If you look at a public company, right? I was just looking at this. The average is usually like high single digits, right? And
no, they're probably
5.
they're probably 20 to 20. The best companies are 20 to 25%.
Right. The best
but the best companies. But yeah, the average, like you said, is probably around 15. Somewhere around there, probably.
So you're talking about several times better than that. Of course, there's a couple of companies I think that are astronomical, right? But for the average company, like you said, if you looked at the S&P 500, say, the return they're getting on invested capital is going to be far lower than these small businesses, which makes it, as you said, the best asset.
Oh, absolutely. Yeah, no doubt. And so once I was able to validate, so when I walk into a client that has the first thing I look at is how much capital do you have deployed? I don't start with a P&L. I start with a balance sheet. How much capital do you have deployed?
Have they seen their balance sheet before?
Rarely. They have to work hard. That thing? Let me get the accountant to print that. And so I get that and I look at it and I eliminate, if they have intangible assets. Okay, that's a fake asset. I don't care. I mean, it's worthless. You have due from related parties. You have a due from shareholder because distributions, but you didn't net it to equity. So the first thing is I look at is okay, what's your equity position? And then I make one more adjustment. How much cash minus line of credit do you have? And if you don't have 2 months of operating expenses in cash, I'm not going to let you have a underreported equity position. I'm going to adjust equity to the 2 month number. Yeah. And if you have too much cash, I'm going to identify how much excess cash you have. And that doesn't go into it because any of the cash that's above the 2 month number is idle cash. You're only getting a return that's equal to the overnight rate. But active cash up to the 2 month number, you're getting your true return on investment, in my opinion, because it's there for a reason, to be a shock buffer to the pops that you're going to get from the market. I don't want you to have more than that number. I don't want you to have less than that number. And so once we come up with it, so if you got $1 million invested between buffer capital, trade capital, and infrastructure capital, I'm going to say, well, guess what? Your minimum profit target is $500,000. And then if you're a only AR or only inventory company, I'm going to say, really, your minimum profit target is $750,000 on that. And so then I go over to the P&L and say, where you stand. And this is kind of where, as I start to plant the 4 corners to the house. So first corner is, are you at 50? Are you at the right return on invested capital for your capital signature? And so is it 50? Is it 75? Is it 100 plus? So I'm going to plant that flag first. Then I'm going to come over and look at it and say, what's your labor efficiency ratio? Looking at gross margin to all labor. And are you below a 2? Are you above a 2? And like I said, if you're a distributor or a retailer, I'm going to look at a 2.5. But those are about the only 2 that would be above it. And so once I get to the LER number, then the next thing I'm looking at is what is your profit to gross margin percentage? Minimum 15%. Target should be 20. 25 is kind of a stretch number, but we've got some that are well over 25. We got some that are kind of cooking in that 30, 35% range. But guess what? They're stuck on growth because they know that if they grew $1 million, they would have to give up on that price. And it starts to infect the work that they've done. The work that they have, they can maintain it at that rate of profit. But for them to grow, they've got to give in on profitability and come back to the more norm. And there again, this is their call. It's not my call. It's their call. I just educate them on what the dynamics are and say, do you want to grow? Does it make sense to grow? If you're $5 million of gross margin at 20% profit to gross margin, you're making $1 million of profit on $5 million of gross margin. Well, if you grow that to 7.5 million of gross margin, but you only make $1.1 million to do it, why did you do it?
Right.
I mean, I've now got $2.5 million more gross margin headaches and not much on the bottom line to show for it.
So this comes into your concept that you took. So not only is it showing you like yearly, this is the return I'm getting, but you started using it for, hey, if I'm going to invest incremental capital to grow from that 5 million to 7.5, I should also get that 50% minimum return. Right?
Exactly.
And then you take care of sort of the, in business school, we learn net present value and IRR and all that. So there's a time value of the money, but you kind of put that into the 50% and said, you need to realize. So like I'm going to go spend more on marketing or open a new store. I need to get a 50% return. You said what, in 12 to 24 months?
There's a handful of industries, we do some work. We got some personal injury law firms. It takes 3 years to grow a case to pay out on average.
Right.
So, okay, if you have an increase in marketing to gain your market share, yeah, you just have to make a longer term bet. It's just the nature of that industry. But the vast majority of industries, like you mentioned, our clients that are the oil change guys, when they go open a new location, they're profitable by the third or fourth month if it's a good location. Some of them, they've been profitable for the first month, which is just amazing. So we've got that one down to really tight. We know what the out-of-pocket is on the investment to launch a new location, and we know the target of what that profit has to be to make that, an A+ location or a B class or a C class.
And so really, when you're judging almost any investment, you should be looking at it, holding it accountable to this 50+% return.
Absolutely.
And I think you have some great examples in the book where you're really looking at it. Hey, like a marketing spend, I spend a little bit here, I get a return. Spend some more, I get a return. But eventually, that return is going to cap out, right? And so you have to stay on top of those investments.
Well, it caps out. And the unique thing about marketing, too, is marketing starts to lose signal value. And you've got to kind of change things up. And one of the examples that a client let us use in the book, that's the actual data, we don't tell who it is, but it was a business that grew from 700,000 to 10 million in 5 years. And it all came from surging marketing spend a little bit every year. And we walked through the decision process that we used each year with them to set the target of what they're going to spend and then evaluate, did it work? And for the 5 years, it worked. But one of the years it didn't, and they learned a valuable lesson from that year. But there again, one of my quotes I always say, I think I put it in both books. I said, a man who aims at nothing hits it with amazing accuracy. And the vast majority of people try things, but they don't hold it accountable to this is what success looks like. And I'm not going to accept anything less than that.
Great. So that's key concept. Then the last thing I want to talk about today was just, I think the other really valuable thing you've done is build this 100 company model. So why don't you talk a little bit about what that is and kind of what it's showing you? I don't know if you've updated it.
Yeah. We got data through March. It's pretty fresh. And so when I started writing the second book, I took 50 companies to do a data set to just do some research to see, hey, what does it tell me? And so a lot of the concepts and stuff I used for supporting information, that research data set. And then once I finished the book, I said, this is pretty cool. I've got staff that can update it. And the advantage for us is every client that we touch their data, we put it into the simple numbers format. So it's exactly the same thing. And so it makes it easy for us to then aggregate data across dissimilar industries. And you start to find they're not so dissimilar either, by the way that we categorize things. And the fact that we've touched the data. The one thing I found, we run a couple of mastermind groups that we don't organize the data initially. We take the data that was submitted and organize it in our structure. But we've taken to where we would rather touch the original data rather than people self-submit because it comes up in the meetings all the time that they just flat out lie on the form. I mean, it's pretty common. So self-submitted industry data is pretty much not worth the paper or the computer screen that it's presented on. So we like this data set because we touch it. I mean, we've interfaced with that client. We know that client. Now, I can't tell you how much we influence the data or not. I mean, I'm sure we do to a certain degree. I'd like to think we do. I think the biggest influence that we have is in the capitalization of the business that we push. We want the 2 months cash, stay off your line of credit. So out of our 100 companies, less than 20 have any balance drawn on a line of credit. And I think if you were looking across the business landscape, you'd probably see 50+% of businesses have something drawn on a line of credit. So I think from the capitalization standpoint, I know we do make a difference because we found a way to communicate why. Now, from a profitability standpoint, we probably move that profitability up a notch or two as well. But still, it tells us, once again, what I'm looking for is movement. Where is the market going? And so it's 100 companies all over the U.S., all different north, south, east, west, all different industries that we don't put our really big businesses in there because they would tend to distort it. So we try to stay less than 100 million in revenue. I think the biggest company that's in there might be around 50 or 60 million. We want that smaller size business. the average, it's $1 billion of revenue typically is with the group that's in there. So that means there's about average revenue is about 10 million. And so that to me is kind of the core group that's that private business. And so then we watch it move. And the first thing when I did, 2013 was my base year. The first thing that shot out at me was our group was up 20% and the government reported 3.5% GDP growth. I go, that's interesting. So I watched it another year and my group was up 14 and they said it was up 3. I watched it another year and my group was up 15 and their group was up 3.25. And then 2017, it shot up to 23%. And that was the year a certain different person took the White House. 2018, it stayed at 23%. But 2019, it dropped to 8. That's before COVID. And that's really where, man, it started screaming the issue that is prime in the U.S. economy and really the global economy as well, is we ran out of labor. I mean, literally in the fall of 2019, we saw that and settle in to where that's where labor starting to get poached. You know, you had to start paying up to keep good people, couldn't find people. And then COVID hits and just totally throws us off the trail. And we're just like a blind hound dog trying to find a rabbit. And it's like, I'm sorry, my nose is working, but my direction's all off. And then we kind of work our way through it. 21, we saw our model shot up to 21% growth. But I can tell you almost all of that was inflation, price increases. Mm-hmm. We work with these companies day in and day out.
In the model, you track expenses, right? And that's when you see expenses. But labor wasn't quite going up that fast then. It was really expensive.
No, it was there.
And then labor went.
The revenue and labor. So typically revenue and labor kind of play this game of chasing each other. Sometimes, so what was happening in late 20 and all of 21 is labor was going up and revenue was having to chase the increase. And then right now, revenue is flat to slightly declining for some businesses and labor is not being adjusted as quickly. And what we've seen develop, there was a couple of things. We started tracking, you just keep asking more questions of the data. And so recently we started tracking the ups and the downs. And so in a relatively stable period, you're going to have 80% of those companies are up year over year and 20% are down year over year. And that was true for 2019, 21, and 22, but not for 20, which that's a COVID year. So it's about a little more, about 55% were down, about 45% were up. But like I said, you got to take that off the table. But what we've seen in 23, and it's continuing, it's about 34% are down and 66% are up. And what we're seeing is, I call it an upstairs, downstairs economy. You can't make one general statement about the economy and be correct because there's some people that are doing just fine. My HVAC guys doing just fine. Plenty of demand. Matter of fact, their demand exceeds their availability of labor pretty much everywhere in the country. And the foresight of that doesn't appear to change anytime soon. You talk about a group that has just been sucker punched in the gut is talk to real estate agents right now, especially anybody that was getting any of the revenue from buyer side commissions. The National Association of Realtors lawsuit that got settled. I mean, that industry, you're going to see probably 40% of the real estate agents disappear.
So I was going to say 40, because the buyer's commissions are gone. They will be gone in July, right?
Yeah. But, we do a roundtable for a group of construction supply businesses. And yeah, they had a really great 22 and 21, but not so much in 23. And they're all kind of worried about where 24 is. And my contention to them is I think they're going to be okay through 24. I think we've kind of gone through this peak and settled into revenues, in my model is showing a 5% year over year increase, which means we're really slightly below zero from an output standpoint because there's at least 5% inflation in those prices, probably closer to 10, to be quite honest, because we push clients all the time to raise prices relative to their cost input. But some of them are in damaged markets to where they can't, or they tell themselves they can't. But I think if you could accurately measure GDP in a service-based economy, I think we're producing less year over year. And people say, well, are we in a recession? I don't think recession matters. Recession is a personal thing. I got 80% of my clients that are up 20% this year over last year. They're not in a recession, but I got 66% of them that are up. but I got 34% of them that are down 17%. And that's not insignificant. Those are the discretionary businesses.
So if you're seeing revenue go up 5%, what are you seeing on the labor side? Is that modified at all at this point? Or
So that
it was
the
going
ups,
crazy for a while.
So the ups, actually, for the rolling 12 through March, the ups are up 14% in revenue. Their labor costs are up 16%. So their labor costs are still exceeding their revenue increase.
And you're saying, and that labor was, well, you had quoted that it was like 50% of gross margin.
What's interesting,
25% of revenue or something like that.
So that 66% that's up, so 660 million of revenue roughly. Well, I think it's actually about 700 million of revenue that we track in the $1 billion plus model. They're up 14% revenue, but their labor costs are up 14, but their total labor efficiency is 2.
And how's profitability, Sam? Like flat?
It is slightly declining because their costs are escalating. And what's interesting is this is where I say it's the monitoring of the movement of direct LER and the monitoring of the movement of management LER tells the story. Direct LER is up 20 cents, which is not an insignificant number this year or last year, which says work harder, make bricks without straw. Management LER is going down even for the companies that are up, because they're protecting their management payroll, thinking this is temporary, we'll be okay. No, you won't. You have to adjust management labor to the income that you have. And now, even to a greater degree, you take the downs, the 34% that are down. So their direct LER is up. Make bricks without straw. Management labor, down. They've cut it some, but they've not cut it enough to reset into the economic reality that they're in. And they're all using hope as a strategy, saying, oh, this is temporary. Well, I don't think inflation was transitory either. So I don't think your economic is transitory.
Because you said we ran out of labor in 2019. Then we had this COVID mess because we didn't really recognize it, maybe because COVID came so quickly, that now we're right back there. So if we have deteriorating management labor, does that mean how do we cut and manage?
Well, my clients who've done it effectively, so I get to see the data. So I've got some that are getting better at management labor. And it's because they've adjusted their business model to not add management labor, even though they found ways to manage more contribution margin before they add another person or add dollars to the bucket or give raises to those people. I guarantee you, I could cut 20% in most companies out of management labor and you wouldn't miss them. You might actually get more throughput because they're not there, because they're actually getting in the way of things.
So you think it's sort of this dead weight, like it's sort of like what's happened in the tech sector, right? Elon came in,
absolutely,
75% of the Twitter employees, and he kept running the company.
Exactly.
So it's dead wood. So it's time to confront, the reality.
Well, and I will say that the companies that have sales labor is where a lot of the weakness is. So this is kind of my other drum that I've been beating as hard as I can hit it, and saying, listen, guys, we're in a new age of sales requirements. I said, the last 2 decades, you've been order taking. Your salespeople have been patting themselves on the back, thinking that they were market making. No, they weren't. They were just being handed a gift of the market. And now you're wondering, where's all the sales at? It was because your salespeople suck and you're overpaying them for what they're doing. And you've got to go back to the drawing board and redevelop real sales talent that takes your hard-earned marketing money that's been spent to get a lead to your door. But I got to take a human to get them across the threshold and get a project initiated. And that last mile of the human effort to get them into an active, especially on B2B sales, I'm telling you, that talent has disappeared from the marketplace.
Yeah, it is a tough. I think there's a lot to be done there. And I'm a big fan of Justin Rothmarsh and his.
Yeah, absolutely. A lot of what he talks about is so good. Yeah.
Well, I've kept you way past the time, 15 minutes past our time. I could do this for the next hour. But
I know we ran out of stuff to talk about, So.
Yeah, right. But there's no more stuff in business. So we'll have to wait till the next mastermind.
That's right.
And then not like you guys need more clients, but people need to come find you. It's simplenumbers.me is the website.
That was the original one. So simplenumberscri.com is, now that we've merged with Cartridge and Ingram, that's the official website. But the simplenumbers.me it redirects there as well. But that's the easy place to find us. I'm about the easiest person in the world to find. So there's not that many Greg Crabtrees. And if you just Google Simple Numbers, we're pretty easy to find.
Just Google Bobcat in the woodpile and it comes right to Greg, right? But just, I think the takeaways here, measure your labor, hold it accountable to the gross margin, look at ROI. This is your business is your best asset. Look at the ROI, hold that investment accountable to that. And then really understand that now that you're measuring that labor, start disaggregating it, because that's where the cost is for your real estate cost.
That's really where you're going to see the labor strategy tell its story of, is my strategy working, or do I need to shift that a little bit? And I would say the other thing that we've really highly pushed of late is we're in a changing marketplace. So I can't look at last year. I can't look at year to date. What I got to look at is I got to understand my business model. What is my total labor efficiency target? What's my profit to gross margin target? Those are the two main things on the P&L to know. And I need to be monitoring it on a rolling 3 basis. I think you've got to get narrow in your focus right now, because this is a marketplace that is going to continue to throw some curves at you. And I think you're going to see reasonably steady demand, but I just had some discussions with clients in the last 2 days that there's people that are starting to play the wait on the election mindset. And so you're seeing some big dollars start to sit on the sideline as we approach November. And then my crystal ball for November is, I don't care who wins, there's probably going to be an argument from 6 to 9 to 12 months. And that's not good for the economy. And so my overarching message is, get profitable with what you got, put some hay in the barn, because I'm probably going to take a shot after the election, regardless of who wins, because of dysfunction in the market. And the worst thing that happens, the market picks up and something good happens and I've got funds to go invest. Great. There's nothing wrong with that. But if I don't have my powder dry and ready to either accept a shock to the system or take advantage of an opportunity, I'm going to miss out.
To add to that, I think sort of the implication of what we've been talking about is, for a lot of companies, where you're going to find that getting profitable with what you got means looking at that management labor.
Number one on the list is management labor. Absolutely.
There's not too much else you can cut out. Well, Greg, thanks so much for doing this. I
appreciate it. Anytime.
We'll talk soon.
All right, good deal.
You've been listening to the Small Business Mentor podcast, brought to you by Alan Pence. For more insights on how to navigate your business through its black holes, visit @apence on X. Don't forget to search for Small Business Mentor in your podcast app to subscribe. Thank you for joining us, and here's to your next leap in business growth.